Is your cash really safe in the bank? We often perceive our hard-earned cash to be safe and secure tucked away in our bank accounts. It's a comforting thought, isn't it? The bank is a fortress, a vault, a sanctuary for our money. But what if I told you this belief is more illusion than reality? While banks do provide a certain level of security, they aren't necessarily the safest place for your wealth. Why, you ask? Well, factors like inflation, low interest rates, and economic instability can erode the value of your cash over time. It's like having a leaky bucket, but the water in this case is your money. On the flip side, there are assets out there that not only maintain their value but can also grow it. They serve as shields against economic downturns and the ever-creeping inflation. If you're intrigued, let's dive into the first asset that's safer than your cash in the bank. Asset number 1, gold, silver, and platinum. When it comes to preserving wealth, these precious metals are the timeless classics. You see, their intrinsic value is a powerful hedge against inflation. When paper currency falls victim to economic instability, gold, silver, and platinum stand their ground, shining bright amidst the chaos. They're not just shiny objects to adorn your neck or wrist. They're a shield protecting your wealth from currency devaluation. Imagine them as the superheroes of your financial portfolio, always ready to fight off the villains of economic uncertainty. And the best part? They've been doing this job for centuries. From ancient empires to modern economies, these metals have proven their worth time and time again. But we're not living in the past, are we? So, while these metals have been preserving wealth for centuries, let's move on to something a bit more contemporary. Asset number 2, industrial commodities. Imagine the world without copper wiring, steel structures, or the gasoline that fuels our cars. It's nearly impossible, isn't it? This is where industrial commodities come in. They're the raw materials that form the backbone of our modern civilization, and they offer a unique investment opportunity. By investing in these industrial powerhouses, you're essentially betting on the continued growth and development of the global economy. And the best part? They provide a hedge against inflation and geopolitical risks. But remember, unlike money in the bank, the value of commodities can fluctuate. However, this volatility also presents opportunities for capital appreciation, making industrial commodities a potentially lucrative investment. Diversification is another key advantage. By spreading your investments across different types of commodities, you can cushion your portfolio against market shocks. While commodities can be a solid investment, next we'll talk about something a bit more liquid. Asset number 3, safe haven currencies. Now let's imagine you're at a roller coaster amusement park. The financial markets are the roller coasters. Thrilling, exciting, but with a high amount of risk. Safe haven currencies, on the other hand, are like the park benches. They're stable, reliable, and a calming presence amidst the adrenaline rush. These currencies, such as the US dollar, Swiss franc, and Japanese yen, offer a sense of stability and liquidity during times of market volatility and economic downturns. It's like having a sturdy umbrella in a financial storm, keeping you dry while everything else gets soaked. But remember, while park benches are great, you're at the amusement park for the roller coasters. Safe haven currencies are a part of a well-diversified portfolio, not the entire thing. They provide balance and stability, allowing you to enjoy the thrilling ride of the financial markets with less risk. Hope you're enjoying the video so far. Don't forget to hit that subscribe button and ring the notification bell. Asset number 4, sovereign guarantee. Now let's take a moment to appreciate the power of a government's promise. Sovereign guarantees are essentially insurance policies for your investments, backed by the full faith and credit of a nation's government. It's like having a heavyweight champion in your corner, ready to step in if things go south. These guarantees offer protection against default risk, which is the possibility that the issuer of your investment might not be able to repay its debt. In other words, you can sleep a little easier knowing that the government's got your back. But remember, not all sovereign guarantees are created equal. Some are as solid as a rock, while others, well, let's just say they might not be worth the paper they're printed on. Always do your homework and consider the financial health of the guaranteeing government. A government's guarantee can be reassuring, but our next asset offers potential for long-term growth. Asset number 5, value stocks and mutual funds. Picture this, a company with solid fundamentals, yet its stock is undervalued in the market. This is what we call a value stock. These hidden gems often come with long-term growth potential and the added bonus of dividend income. They're not flashy, but they're reliable, and sometimes, that's exactly what you need. Now let's add a twist. Imagine a basket full of these value stocks, handled by financial experts who do the heavy lifting for you. This is a mutual fund. Mutual funds pool money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other assets. They're a great way to dip your toes into the investment world without needing to become a Wall Street whiz overnight. In a nutshell, value stocks and mutual funds offer a blend of stability and growth, making them a solid choice for savvy investors. Now let's move from the stock market to the property market. Asset number 6, land and real estate. Now here's something you can literally stand on. Land and real estate have long been seen as solid investments, and for good reason. Unlike stocks or bonds, they're tangible assets. You can touch them, live in them, even rent them out. The potential for rental income is a big plus. It's a steady stream of cash flow that can weather economic fluctuations better than many other investments. But there's more. Real estate can also appreciate in value over time. In other words, that humble house or patch of land you buy today could be worth a lot more in the future. And here's the cherry on top. Land and real estate are excellent hedges against inflation. As the cost of living goes up, so does the value of your property. If you're enjoying this video, clicking on the like button would be greatly appreciated. Asset number 7, collectibles. Welcome to the fascinating world of collectibles, where art, antiques, and rare coins hold the stage. This isn't your typical investment avenue. It's an eclectic blend of passion, knowledge, and a dash of fortune. Collectibles have the potential to appreciate in value over time, often outpacing traditional investments in a buoyant market. Picture this. A rare comic book you bought for a few dollars at a yard sale decades ago could today be worth a small fortune. Or that vintage wine collection gathering dust in your cellar, it might just be your golden ticket. But remember, this isn't a game of luck. It's about understanding the market, knowing what to collect, and when to sell. And the best part? It's not just about the money. Collectibles offer a unique joy, a connection to history and culture that few other investments can match. Collectibles can be fun and profitable. But now, let's move on to a more traditional investment. Asset number 8, bonds. Now here's an asset that's as steady as a rock. Bonds are essentially IOUs issued by governments, municipalities, or corporations, promising to pay you back your initial investment along with fixed interest payments. It's like lending your friend money, but this friend is really reliable and always pays you back with a little extra for your troubles. The beauty of bonds lies in their stability. While the stock market may be performing a volatile dance, bonds maintain their composure, offering a level of predictability that's comforting in the financial world. And let's not forget about those fixed interest payments. They're like small gifts that keep on giving until the bond reaches maturity. So, if you're looking for an asset that offers a smooth ride with a steady return, bonds might just be your ticket. Bonds offer stability, but our next asset offers diversification and liquidity. Asset number 9, exchange-traded funds, or ETFs. Now here's a financial instrument that packs quite a punch. Imagine if you could buy a basket of stocks, much like a mutual fund, but with the flexibility to trade it like an individual stock. Sounds pretty nifty, right? Well, that's an ETF for you. They offer diversification, spreading your risks over a range of stocks instead of putting all your eggs in one basket. But wait, there's more. ETFs are also known for their liquidity. You can buy and sell them throughout the trading day at fluctuating prices. Last but not least, ETFs typically have lower expenses compared to mutual funds. This is because most ETFs are passively managed, aiming to mimic the performance of a specific index rather than trying to beat the market. So, in a nutshell, diversification, liquidity, and low expenses. ETFs can be a great investment, but our next asset is a bit more cutting edge. Asset number 10, cryptocurrencies. In an age where technology is king, cryptocurrencies have risen to prominence as alternative assets. These digital currencies, like Bitcoin and Ethereum, have shifted the financial paradigm, offering a unique combination of decentralization, security, and potential for high returns. Decentralization means no central authority can control your funds, your money, your rules. Then there's the security aspect, where transactions are encrypted and stored on a public ledger known as the blockchain, making them transparent and resistant to fraud. But it's the potential for high returns that really turns heads. Remember the Bitcoin boom of 2017? Of course, with potential reward comes risk. Cryptocurrencies are notorious for their volatility and are subject to regulatory scrutiny. Despite the risks, their popularity continues to surge, proving that in the world of finance, innovation is always in high demand. Cryptocurrencies are exciting, but our next asset offers a chance to play banker. Asset number 11, peer-to-peer lending. Peer-to-peer or P2P lending is a revolutionary approach to borrowing and lending. It's a platform where borrowers and lenders meet, cutting out the middleman, usually banks or financial institutions. The borrowers can secure loans at competitive interest rates and the lenders can enjoy higher returns than traditional savings accounts. Here's the fun part. These platforms are open to individuals and businesses, meaning you can become a lender too. It's just like being a mini bank, minus the sky-high overheads. But remember, as thrilling as playing banker may sound, there are risks involved. Borrowers can default, and unlike banks, you don't have an army of collectors at your disposal, so it's always wise to diversify your investments to minimize risks. At number 12 we have dividend-paying stocks. These are shares of companies that regularly distribute a portion of their earnings to shareholders in the form of dividends. It's like having a steady stream of income on top of the potential capital appreciation of the stock itself. But remember, not all dividend-paying stocks are created equal. Some companies may offer high dividends one year, only to cut them the next. Therefore, it's crucial to do your research and choose companies with consistent and strong track records of dividend payments. Adding dividend-paying stocks to your diversified portfolio can provide regular income, which can be particularly useful in retirement or as a buffer during market downturns. It's like owning a piece of a profitable business that shares its success with you. But, as with all investments, there are risks. The company's earnings could fall, it could cut its dividend, or the stock price could decline. So ensure you understand these risks and are comfortable with them before investing. At number 13 we have annuities. Annuities are insurance products that you purchase with a lump sum investment. In return, you receive regular payments over a specified period or for the rest of your life, providing a steady income stream during retirement. This makes annuities a popular choice for those looking for financial security in their golden years. But remember, just like any other investment, annuities come with their own set of risks and considerations. They can be quite complex, and often carry higher fees than other investment products. Therefore, it's crucial to fully understand the terms of your annuity contract before making the investment. Be sure to consider factors such as the payout rate, the length of the payout period, and any potential surrender charges or penalties for early withdrawal. Despite these complexities, when used correctly, annuities can be an effective tool for managing retirement income. They offer a unique combination of guaranteed income and potential for growth, making them a valuable addition to a diversified investment portfolio. But, as always, it's important to consult with a financial advisor to ensure that an annuity is the right fit for your individual financial goals and risk tolerance. From the promising world of annuities, let's now move on to a more conventional, time-tested asset. Certificates of deposit at number 15, or CDs. CDs are essentially a type of time deposit offered by banks, with a fixed interest rate and a set maturity date. They are considered a safe investment as they're insured by the FDIC up to certain limits. You invest a certain amount of money in a CD for a specified period, and when that period ends, you get your original investment back along with accrued interest. The appeal of CDs lies in their simplicity and the safety of the principal investment. However, it's worth noting that the returns on CDs are typically lower than other investments like stocks or bonds. This is the trade-off for the reduced risk. Also keep in mind that CDs come with certain restrictions. For instance, you usually can't withdraw your money before the maturity date without paying a penalty. And although they are considered safe, the returns may not keep up with inflation, which could erode the value of your savings over time. Therefore, CDs are best suited for conservative investors with a low risk tolerance, or those looking for a safe place to park their money for a short term. As with any investment, it's essential to understand what you're getting into and align it with your financial goals. As we've journeyed together through this diverse landscape of assets, one thing becomes clear. There are safer and potentially more rewarding places for your money than simply leaving it in the bank. From precious metals to cryptocurrencies, from stocks to real estate, each of these assets offers unique opportunities for wealth preservation and growth. But remember, the secret to financial success isn't just about choosing the right assets, it's about diversification and risk management. Diversification is the process of spreading your investments across various types of assets to reduce risk. If one asset performs poorly, others might perform well and offset the losses. Risk management, on the other hand, is about understanding your risk tolerance, setting realistic financial goals, and making investment decisions that align with these goals. As we continue to explore the fascinating world of finance, we encourage you to engage with us. Leave your comments, questions, or suggestions below. Don't forget to subscribe to our channel for more insightful content. Remember, financial savvy isn't just about making money, It's about making informed decisions. Until next time, stay financially savvy.